So joining us next is Neil Hunt, who's a Eurodollar options trader out in Chicago. And Neil was nice enough to email me some of the observations he was making in the Eurodollar options market. And I was just amazed by some of the stuff he was observing. And I thought it would be amazing to bring him on to the show. So welcome, Neil.
Hey, thanks. Yeah, thanks for having
Yeah.
me.
And Neil, the first thing that I want to do, because I want to get right in, I want to get into that big whale Condor trade and other things in there, but I wanted to just start off for our listeners to explain what the euro dollar markets are, because it's not the currency we're talking about in terms of euro dollars. Why don't we give all of our listeners just a quick rundown?
Yeah, so Eurodollar in this case, yeah, we're talking about short-term interest rates, right? So we're, the most, so right now, today, what they do with is for 3-month LIBOR, they take, that is the London Interbank offered rate, and what they do is that they take survey of, I don't know, it's like 12 or 20 banks or something, and these are all banks that are, not in the United States. And they take a survey and they say, okay, you're going to lend to another bank for 3 months. You're going to lend $1 million. Like, what's the interest rate? And then they do that on different time frames: the overnight rate, 1 month, 3 months, 6 months, etc. And then every single day that isn't a holiday, the ICE, the International, or ICE Exchange, I don't know what it stands for, they publish these rates every morning. So today it was, today was 256. And yes, it correlates, quite strongly with, Fed funds. So, people are involved in the futures market, that are anyone that's interested in the Fed and what they're doing, people get involved in this. But yeah, as you can see here there is a little more to it than just the Fed funds rate. So the Fed funds effective rate today was 241. LIBOR was 256. So, there's a 15 basis point difference there. What this chart is showing is actually slightly different. So because on this chart is actually it's a swap rate that's supposed to be forward looking to
Right.
make
Yeah.
because LIBOR itself, or Eurodollar futures, themselves are a forward looking 3-month rate.
Wasn't
So, and just stop me if I'm getting too.
Yeah, no, no, but Neil, wasn't it for the longest time that the TED spread was the most commonly observed way of looking at that spread? Like right now, the OIS spread is the one that is most commonly looked at. Do you know why everyone made that switch over, or am I even
I don't.
describing it right?
Yeah, I'm trying to think. Like, well, the TED.
It's because
what does that
it's
stand for
Treasury.
again? Is
It's
that,
Kevin here.
it's-
It's because it was Treasury bills against
Yeah.
Eurodollars, and I just don't think that Treasury bills trade as much anymore. And I think that there was at one point there was a futures contract on Treasury bills, but it just didn't go,
Yeah.
and Eurodollars replaced it. And the important thing I think that for our listeners to understand is that the Eurodollar is really U.S. short-term money that is traded offshore. So it's the rate upon which banks lend to one another overseas. Right.
Outside of the
and
Fed
so
system.
that
Yeah.
ends up being the true cost of money, kind of from a short-term perspective. And the Eurodollar futures contract is a series of contracts that is basically betting on what this 3-month rate will be in the future. So so if you go and you buy December 2019 Eurodollar futures contract, you are in essence betting on what that 3-month rate will settle at, whatever the settlement date is in December. So it's almost like if that's a 9-month period till expiry, it's really like a 12-month instrument. So that's kind of the
Right.
important thing to realize. It is interesting that you're pointing out the fact that it is not exactly like the Fed funds, and I think you talked about some of the reasons that why people trade Eurodollars versus Fed funds is the fact that the Eurodollar instruments are actually a lot more liquid. Are they not, Neil?
Yeah, I mean, yeah, that's true for sure. the LIBOR, one of the things, and you've been hearing more about LIBOR in the news, is because, there's like, trillions of dollars of all these, floating rate mortgages, or all these, financial instruments that are all based off of essentially this rate, this LIBOR rate. I mean, it trickles down to even, your own savings account, if you have a savings account. Of course, if your savings account at, one of the really big banks, you're still getting like 0.01%, right? But if, for instance, there's certain banks, online banks now, I know, that are paying 2.25%. So, on a savings account. So that's, and that's related to, they move that rate up when Fed hikes rates.
So the Eurodollar futures market ends up being the most liquid of kind of, if you wanted to speculate on short-term interest rate movements. This is the most liquid instrument. I think I looked at the open interest is $1.65 trillion, like trillion, like with a T, not.
Yeah, I mean it's
and
crazy.
The biggest money market
in
the
the
world.
front month, like what are the months like when I go look at the December contract? What will be on the bid and offer in terms of how many contracts?
Easily. Many thousand.
Yeah, like it's like sometimes it's even 100.
It obviously goes back and forth, but 50,000 up is common, even all the way through maybe So the fronts are called the whites, the 1 year out are called the red futures. So through the reds, you can even find maybe 20,000 up. But a lot of that's algo driven. So so these guys are. They're following obviously all the rules, but the way the rules are written, you're able to put a lot of size on there to get allocated. When a 10 lot trades, you get allocated your 1 lot if you have so much size on there. It's a pro rata algorithm.
Fair enough.
Right.
So
that juices the bid and offers for sure.
Okay.
And is that's those are the current rules, but it is a point of contention amongst many people as to what is fair, right?
Yeah. So Neil,
people are going to take advantage of the.
Yeah.
Yep.
So Neil, I want to move on because I want to get back to this Condor trade. So what you predominantly trade in the options markets on this, and you saw this huge whale of a trade go through, and it was I drew on the Condor trade that someone put on the Eurodollar futures, but and what was fascinating about it is it was 500,000 contracts that someone put on here, and I think, correct me if I'm wrong, it was somewhere near around 4 ticks that they paid for it, correct?
Yeah, I think it was an average price, but I think 4, maybe just under 4, if I recall. Yeah. So,
and it's not that big of a payoff because the most it could pay off is 12.5 ticks. But clearly, somebody was fading the enthusiasm of lower interest rates, right?
Yeah, definitely. I mean, they started putting it on. Essentially, we had right on that chart that you're showing. There was the March. We had the March meeting, which was no one thought it could be more dovish than people were already expecting, and it was. So you had the March meeting was the first up day. I think you have your mouse on it right now, followed by an unch day, then up big. And right at the top there is where this guy started putting these on.
So he started fading it at that point. Like he thought that basically he thought that it was overdone and that it wasn't going to.
Yeah, definitely overdone. And if you're actually listening though to what the Fed is saying, they've said they're on hold now. So this is a bet that they're going to stay on hold. Now, as I was saying, because of the this OIS spread, other things now, there's other things involved where he could miss, right? Even if they stay on hold through the end of the year, he could miss because, you have these different credit issues, funding things that can come out of nowhere, particularly, at the end of the year end, month end, quarter end, you tend to have these, funding things. So,
right.
But the one he chose would be, where LIBOR is right now. LIBOR is 256. So, right if all else being equal today, it would be going out. It would be going outward
Right.
6. All else being equal today.
So Neil, when someone puts on a huge whale trade like this, what is the tendency for them to close it out early, or is this one when you open in this kind of size, like 500,000 contracts? Is this pretty much something that this trader will hold to maturity? Like, what is their tendency when you see something like this, or am I just?
Yeah, I mean, you have guys that I think it's not necessarily only one person. Your fund, whatever. I always say guy, but it's we call it paper, right? So anybody that's not we call ourselves locals. Anyone that's not a local, you call paper, basically. So but there can be piggybackers, right? Some people, maybe one guy, your one hedge fund bought 100,000, then someone else said, "Yeah, man, I agree," and then they, people piggyback, sort of thing. So, but yeah, and then each person, each would manage it their own way. But some of these bigger hedge funds, they tend to, they will not let you out. They hold it all the way.
So when it gets Kevin.
Right.
Maybe at the very end they'll they move things around. Sometimes they'll do a call spread or put spread to kind of move some strikes around, take some profits. They can, things like of that nature.
So Neil, it's Kevin here. One of the things that I noticed when I was looking at this, and I was actually talking to another Eurodollar futures kind of trader, and he was telling me that the market makers are talking about the fact that the skew is as steep as they've ever seen. And I was wondering if you wanted to comment about that. Like, do you agree with that? First of all, is the skew as steep as you've ever seen? And if so, what's driving it?
Yeah, I mean, I do. I agree. It's actually it's come back some, I guess. Relatively speaking. So it's still, the the call's still trading, well over the put, but it has, I would say, right in those Fed, from that March meeting, those up days, then the subsequent kind of back down days is where the skew maybe would peaked, kind of in my mind. The Condor that was put on was part of that. So they, when they're trying to pick, you pick strikes, you find, you can see right in this, perfect to put this chart up now, that how the curve looks, because you can see it's almost like there's a big kink, right in that area that this guy thinks where we're going to end up, and I'm looking at the bottom right graph there.
So
right.
So you can see it's not like a normal smile. You have it all of a sudden it's just a kink going down, and that's the kind of thing that this is why the Eurodollar option market is quite unique, because versus trading corn or something like that, where you don't it's a price, it moves up and down. You can't. LIBOR is an actual thing. It's fixed every day. So and the Fed is either going to hike or they're not. And so these things they become more binary in nature. So they're harder to model, and it's common to see crazy things like this. But yeah, in terms of
like,
the,
I had a look, and the December contract, the out of the money puts are trading like 11 to 12 in terms of vol implied, and I'm showing the calls,
Right.
The big out of the money calls are trading north of 20. So we're sitting there, and it's almost 10% of vol skew spread. I'm kind of I cut my teeth on index trading in terms of in stocks, so I'm used to the smile or the kind of half smile, but I'm used to it being the other way. I'm used to it being the puts more expensive, and it was kind of shocking to look at this and see how expensive the calls were. You don't think, I guess my question to you is this unique because of the fact that everyone thinks the Fed is going to cut? Like, do you think that there's something more going on that sorry, go ahead. I'll let you go.
Well, I think it's, to me, I think the fundamental kind of reason why it makes sense to have the calls over, trading over the puts right now. It's not always this way, but why right now? I mean, the real fear is to the upside. The fear is that stocks, just similarly, in the equity markets, puts are trading over, because the fear is that, it hits the fan.
Yeah, you can say it. The shit hits the fan.
And in our product, it's the same way that they're going to have to emergency cut. You know, they're going to have to emergency cut 50. You know, like there's some sort of terrible event, and they're going to, you know, tomorrow they emergency cut 50. Right? I mean, it's just that upside fear that we could shock higher, whereas, you know, if you know, even if the next move were to be a hike, I think this, you know, Fed in particular, you know, Powell has made it pretty clear that he's going to telegraph it for a while in advance. You know, I mean, we haven't had a hike or pause or anything that wasn't almost 100% priced in. You know, the whole market knew it was coming. That's kind of how this Fed is. They don't surprise people. So the only potential surprise, you know, the biggest surprise would be higher, and so people fear it, and so they want to own that up there. Is kind of the way I look at it.
Okay, so.
But yeah, what's interesting is.
Sorry, go ahead, Neil. Go ahead. I didn't mean to interrupt you.
Oh, well, I was just going to say, you know, when I started in 06, so it's like, you know, I'm still a youngin' for some, you know, some say, but yeah, what I remember is people used to say, no, the skew is to the put because it just purely based on like credit risk things. So, you know, you have had LIBOR spike out. And what's funny is people right now, that's another thing, people just completely forget about. They just don't, you know, they're so short, you know, sighted sometimes that, you know, I believe in 2010 there was a Greece thing, you know, if you're looking at just a long-term LIBOR chart, you'll see it kind of spikes out for a few weeks or so, and there's a panic and the puts go crazy, vol goes crazy. You know, certainly in the 07, 08, there were various times where it spiked. So because of that, like if you have a sort of credit event, you actually, what's interesting is people are fearing the upside because of emergency cuts, but what could actually happen in the most front month is that LIBOR spikes out and you actually go the other way. That's what's really interesting.
I completely agree because I noticed that as well. If you go back and look through history at LIBOR and you'll realize that at times of stress, the volatility is actually both ways because of that credit portion. And obviously, everyone remembers back in 08 that no bank wanted to lend to each other. And even though the Fed was cutting rates, the rate for LIBOR was spiking to the moon. So if you were long, you know, Eurodollar contracts, expecting that to save you, then you were actually, it was really difficult. It didn't do that. And in fact, it ended up going the other way for periods of time. So it is actually really interesting that the market has forgotten that risk to the downside. And I didn't realize it, but I guess what you're saying is that at times it actually is priced the other way, and the skew is the other way, where the puts are actually at a higher implied volatility than the calls. Is that correct?
Yeah. Specifically the 2016 election, right? I mean, yeah, obviously that caught equity markets, you know, that overnight move that occurred on the election, you know, I mean, what was it, limit down and then all the way back to higher and, you know, then exploding from there in equity terms, right? For us, it was kind of the opposite, way higher. Everyone's like, oh, okay. And then we're just start going way lower. And, you know, the puts, I mean, I would say at that point in time, you know, the skew went extreme the other way, and the puts were trading maybe, you know, in just basis point terms, you know, a couple ticks over the calls.
So 1 second.
That caught a lot of people off guard.
Sorry, I'm going to actually jump in here again. It's Kevin. So Neil, I have one last question for you in terms of this whale comes in. He wants to buy this Condor, or they're gobbling up all the calls because everyone's worried about this. Who's selling it to them, and are they the weak hands, or is the buyer the weak hands? Like, I kind of wanted to understand the market positioning about like who is on the other side of that whale's trade.
Yeah, no, it's a good question because I ask myself a lot all the time. I mean, the way everyone trades differently, but kind of, you know, I am a market maker, but the way I look at things, I try to, you know, part of the reason I'm a fan of you guys is that, you know, I try to keep a more macro view. But yeah, who's on the other side? You know, mostly, you know, there's a lot of locals and, you know, big firms, market making firms that are willing to take down, you know,
that sort of size.
a lot of size, basically. So they are on the other side, and then their strategy is that through smaller opposing order flows, they're going to be able to lock in some edge, lock in some money. So that's they're playing it that, market makers are here every day, right? So the one big trade goes through, it can kind of push things out of whack, but then there's going to be a bunch of other little trades that
So one last question.
And not to mention, the guy could come back, make an adjustment. So, for instance, just the bottom portion, so it's the 97 spot 125, 97 spot 25. Just that put spread, someone has come in and bought for decent size, maybe like 100,000, 200,000. So, is that somebody different? Is it the same guy? Again, you don't really know, but for instance, that has been an out that locals have had.
So one last
to get out
one last question to leave us with, Neil. Are the locals on the whole short gamma, or do they figure out a way to buy some gamma? Like, who is short the gamma? Is it the locals and the market makers, or is it the clients?
Like from this trade?
No, in general, the whole square, generally, like the whole square are there's a lot of big trades happening going through the tape on these Eurodollars, and on the whole, are the locals, like, are they the ones on the other side selling the gamma? Other clients, are there the PIMCOs of the world selling it, or is it who's short the gamma?
It goes back and forth, to be honest. I think, in general, you have locals that are mostly short gamma, but you also, there's so many like vol selling funds now, and they'll do stuff in the longer end, like the 2-year, 5-year, 10-year, right? And then there's people, and then that trickles over, and vol is cheap. So, to be honest, it's hard actually to know. Especially after vol has just come off a fair amount with a Fed meeting and a payrolls this week. So, but I think in general, locals, depending on some locals trade long, some locals trade short. So it kind of just depends on their own thing. But paper, they usually, especially in the front end, so when they're trying to pin a strike, it's all short. They're getting short. They're short gamma. They sell the strike they think we're headed to, and they try and bury it basically, as and you can see it reflected in the common paper trade. They're not happy with necessarily just like a butterfly, right? A put butterfly now. They want to do a 1/3/2, right? So they'll or some other ratio that's taking actually even more risk and selling more.
Okay. So they're the ones, they're selling a fair bit of gamma. Anyways, we have to cut it short there. Thanks a lot, Neil. It's been a pleasure, having you on, getting your color from the Eurodollar pits, and we hope to have you again in the future.
Yeah, no problem. Thanks, guys.
Thanks, Neil. Cheers.